Ladies and gentlemen, good day and welcome to the Q3FY22 financial results conference call of Brigade Enterprises Limited. We have with us today the management of Brigade Enterprises Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. M.R. Jaishankar, Chairman and Managing Director of the company. Thank you, and over to you, sir.
Thank you. Good afternoon, ladies and gentlemen. I hope you and your loved ones are doing well and not that affected by the third wave. I would like to welcome you to the earnings call for the third quarter of financial year 22. I am joined by our executive directors, Roshan Matthew, Pavitra Shankar, Nirupa Shankar, Amar Mysore, and our senior management team, Mr. Atul Goel, CFO, Rajendra Joshi, CEO Residential, Vineet Verma, CEO Hospitality, Subrata Sharma, COO Office Business, Om Prakash Company Secretary, and Pradyumna, the Senior Vice President. We are happy to report that Brigade witnessed improved profitability in the last quarter. In the residential segment, buyer sentiment continues to be positive as witnessed by the demand in our ongoing and completed residential projects, with Brigade continuing to be the brand of choice for customers seeking to buy a new home. We registered net bookings of 3.13 million square feet with a value of 1,957 crores for the 9-month period ending December in financial year 22. And for the quarter of FY22, net bookings of 1.08 million square feet having a value of 680 crores is done. This is a growth of 10% by area and 17% by value versus the 9-month period of FY21. We faced some delays in plan approval and therefore launches due to a Karnataka High Court order on the local authorities which affected all developers. Of course, some of the developers were able to launch the projects which were approved earlier than the Karnataka High Court order. We are hopeful that the recent resolution of the matter will enable us to resume our residential launches soon. On the residential collections front, we registered our second best quarter so far of rupees 842 crores, driven by continued strong sales performance and good construction progress at all project sites. Hyderabad and Chennai continue to be important markets for us, contributing 27% by area and 36% by value in Q3. In Bangalore, our key projects, Brigade Cornerstone Utopia and Brigade Eldorado, are the primary contributors in under construction projects, and followed by Brigade Exotica and Brigade Orchards in completed projects. The leasing segment of the commercial business remains stable with 99% collections. Transactions in Q3 gained momentum, confirming our earlier positive outlook for the quarter. We transacted 0.4 million square feet, that is 400,000 square feet, which is consistent with our expectations, and also we have a strong pipeline in excess of 800,000 square feet or 0.8 million square feet. The trend is consistent with robust hiring across IT and ITS and financial sectors, and therefore the need for additional space. In fact, the RFPs, that is the request for proposals for large requirements, have increased, besides the requirements for small and medium-sized offices. The retail vertical saw a bounce back to pre-COVID sales consumption numbers in Q3. In fact, we achieved 100% sales consumption recovery over Q3 of FY20, that is the FY20, which is the pre-COVID period, for like-to-like brands. Performing categories were food and beverages, travel gear, anchor stores, and athleisure. Multiplexes across all our malls achieved higher levels of occupancy and sales for November and December due to relaxation of COVID guidelines. There was good traction with respect to our mall leasing. Almost 23 units measuring about 100,000 square feet is under fit-out in all our malls. These brands will be operational by end of Q4 financial year 22 or in few cases Q1 of financial year 23. Our hospitality business saw a significant demand revival across our portfolio in Q3 with a good segmentation mix of travelers. ARR's average room rates have grown gradually to touch 70% of the pre-COVID levels, and even occupancy had reached 90% of the pre-COVID numbers, showing an encouraging growth trend. While corporates continue to operate in a work-from-home mode, our hotels did witness an uptick in demand from corporate travel, domestic corporate travel, with almost 25% of the room night sales falling under this category. Another positive was the banquet sales across hotels. Despite the restriction on number of guests, we could host over 200 plus social and corporate events in our hotels. We consistently remained GOP positive throughout the Q3. That brings me to the end of our business highlights, with 2.4 million square feet in real estate and 1.8 million square feet in lease rental planned in the next quarter. We have a lot to look forward to. Of course, more projects will be planned and launched in the subsequent quarters of FY23. Thank you for listening. I now request our CFO Atul Goyal to take you through the financial highlights. Take care and stay safe. Thank you.
Thank you, sir. And good afternoon, everybody. On behalf of the company, we welcome you to the earnings calls of Q3 FY2022. To start with the company update for Q3, we recorded a real estate sales of 1.1 million square feet during this quarter, vis-a-vis 1.3 million square feet during last quarter. We also saw a significant jump in collections in Q3 FY2022, which totaled up to 1095 crores in Q3 FY22. In fact, we have crossed our collection in 9 months what we had collected in last year. So that has been a very good collection by the company. Our lease rental vertical also witnessed traction, where 4.4 million square feet was leased during Q3 FY22. We have an active pipeline of 0.8 million. On retail side, we achieved 100% sales consumption, as MD said. On like-to-like brands, multiplexes have performed well due to new releases during the quarter. Our hospitality portfolio showed strong signs of recovery, with the occupancies reaching a pre-COVID levels of 62% in December 21. Hotel portfolio achieved HUP of 167 million during Q3 FY22, an increase of 99% from Q2 FY22 in absolute terms. Restriction in January 22 is likely to have a short-term impact. However, we continue to be optimistic with increased vaccination coverage and uptick in air travel. On consolidated level, there was an increase in cash flow from operating activities by 60% from last quarter. We continue to have adequate liquidity and undrawn credit lines from banks. Our average cost of debt has been coming down consistently over the last few quarters and was at 7.81% as on December 21 versus 9% as on December 20, a reduction of 119 bips. Coming to consolidated financial performance for Q3 FY 2022, the consolidated revenue for Q3 FY22 stood at 933 crores versus 776 crores in the previous quarter, up by 20%. The real estate segment clocked a turnover of 703 crores and EBITDA of 22% in Q3 FY22. The leasing segment clocked a turnover of 167 crores and EBITDA of 58%, which is mainly because of some one-time expenses which has come this quarter. The hospitality segment clocked a turnover of 62 crores and EBITDA of 29% in Q3 FY22. The consolidated EBITDA for Q3 FY22 stood at 270 crores. EBITDA margin stood at 29%. Consolidated profit before tax for Q3 FY22 is 75 crores. Coming to debt position and its breakup, again there was a reduction of around 52 crores in real estate debt, which has been driven by high sales and collection during Q3 FY22. The cash and cash equivalents stood at 1,312 crores as on 31st December 21. Consequently, the company's net debt outstanding as on 31st December 21 is 2790 crores, out of which BL share is 1856 crores. Almost 78% of the debt pertains to the commercial portion, of which 74% is backed by lease rentals. We have a credit rating of A+ with a stable outlook, which has been assigned by both CRISIL and ICRA. I now hand over back the mic to moderator for questions.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Siddharth Dung from Goodwill. Please go ahead.
Yeah, hi. I just wanted to get an understanding of our commercial assets. What is the average lease duration, mark to market that we have, of the current rentals that we are getting, and the kind of expiry we'll see in the next 1-2 years? Hello, can you hear me?
Yeah. So this is Subroto. In terms of the lease tenure, it's normally 5 years, and in many of the cases it is 5 plus 5. And so far as the renewals are concerned, this year we have already achieved 98.5% renewal. There were almost like 4.68 lakh square feet renewals that have come up. So we have renewed almost everything. And with regards to market, all these renewals have happened in terms of like the normal lease tenure that was like agreed upon. So there was no discounted rental that was offered.
Okay. And what can we hit like 90-95% occupancy rates in the upcoming future, like in a couple of years, or do you think that'll be tough?
What you are asking, like in terms of renewals?
No, in terms of occupancy of the asset.
So occupancy, we are quite hopeful. See, basically, currently we have approximately 2.4 million approximately to be leased. And the way the market is shaping up, last quarter has been very good. And the outlook is also very good. We hope to actually cross 90-95% within the next 3 quarters at the max.
Okay. And what would be the per square feet rentals that you are expecting in these properties?
Again, it depends upon the micro market. So essentially, like if it is like east of Bangalore, we are achieving 60 plus. If it is north of Bangalore, we are achieving 75 plus. Chennai, we are achieving 85 plus. So again, it depends upon like which property, which micro market.
Okay.
In most of the markets, we are achieving a premium. Okay, like in East Bangalore, we are achieving almost like 3 to 4% premium over the weighted average rental of the micro market.
Okay, and you had mentioned that you've got some you keep getting unsolicited offers, for these assets time and again. So around what yield would the market, be willing to buy these assets at?
So again, it depends like what kind of tenancy, what kind of property, normally anywhere between 7 to 8% cap rate.
Okay, perfect. Thanks a lot.
Thank you. The next question is from the line of Adidev Chattopadhyay from ICICI Securities. Please go ahead.
Good afternoon, everyone. Thanks for the opportunity. So my first question, you alluded to some Karnataka High Court order for which there has been a delay in the launches. Could you help us understand the reason, and has this been resolved, or what will it take for the matter to be resolved? Just wanted some clarity on that.
Sorry, the issue is resolved. See, due to some application, writ petition of some applicant, the High Court said the local authority should not collect almost 80% of the plan approval charges they were collecting. So the local authorities stopped approving the new plans because 80% of the plan approval charges means it ran into hundreds or few thousand crores to the local authority. So the matter got, I would say, sort of resolved by a fresh government order by the Karnataka government overruling the Karnataka High Court order. So it is back to normal. And we did, by and large, the recognized developers did not challenge it. It's only, a stray case somebody challenged and a stray order which, resulted in this confusion. The issue is resolved.
Okay. So, and if I heard correctly during your opening remarks, this 2.4 million square feet of launches may either happen in this quarter or the next quarter. Is that correct?
Yes, correct. It's bulk of it we'll try to do this quarter, but sometimes some RERA approval and things like that, if it takes time, it may get pushed into the first quarter. Otherwise, these are all plans where we have approvals and in some cases out of maybe 50% of 2.4 million square feet, we have RERA approval also. The balance is under RERA, we are seeking RERA approval.
Okay, you already have the approvals in place for 1.2 million square feet. Okay, yeah. Okay. Second question is on our rental, as Mr. Subroto, I think, alluded that this balance 2.4 million square feet, we are hoping to lease everything, if I heard correctly, by September. You could just help us understand which properties you are expected to see more traction, and what is giving us this confidence on the same? Yeah.
So basically, what I meant was 95% plus occupancy over the next 3 quarters. So the way we are seeing the pipeline develop, the max pipeline is at Brigade Tech Gardens, where we have the maximum vacancy as on date. But at the same time, the pipeline and the kind of average size of the transactions that we are getting and we are actually closing, that's like significantly large. So that is on the top of the list. Plus, Chennai market has also started shaping up. Though in Chennai, the large size pipelines are still not as significantly large as in Bangalore, but a lot of mid-sized companies are actually now gotten quite vibrant. So essentially, it's like BTG on the top of the list, followed by Chennai, and then we have like BIFC. In any case, Gujarat is doing fantastic. Over the last 2 quarters, we have done quite a good number of transactions.
Okay. So just sorry for a follow-up. This 90-95%, obviously you'd get the leasing done once, and they would take 4 to 6 months for the fit-outs, right? So I think earliest the rentals may start by when? By January of 23, or you could just help us understand how the occupancy and rental commencement.
From the closure date, you can take on an average 6 months because of late the ask for the rent-free period has increased because of COVID scenario. The fit-outs are normally slow, so we can expect around 6 months of rent-free period from the lease commencement date.
Okay, so but definitely by March of next year, I'm saying 23, we should be more or less done with the leasing. That is your internal target.
Yes, that's what we are also targeting, and we expect. The way pipelines are actually tracing. In fact, it was going on quite well because of the Omicron. The physical site inspections got subdued a bit, but the requirements are there in the market.
Okay. And sir, just last question, this is for Atul. Sir, if you could just share the numbers for Tech Gardens and WTC Chennai for the 9 months, what is the income from these 2 properties? Gross, not our share.
Yeah. So gross rental income in Tech Garden has been 76 crores.
Yeah.
and in PREPL it is 84 crores.
Okay. Sir, any increase expected in this run rate from the fourth quarter? Means the quarterly run rate, like take got is 25 crores.
Run rate will continue because it's a straight lining method how we are recognizing the revenue. So we don't anticipate any increase right now. But if there is an increase in leasing, definitely the run rate will go up.
Okay, fine. I'll come back in the queue if I have got more questions. Yeah. Thank you and all the best.
Thank you. The next question is from the line of Karan Khanna from White Oak Capital. Please go ahead.
Hello.
Yeah, please go ahead.
Yeah, this is Karan from Ambit. So my first question is, we know that you expanded land bank across Chennai and Bangalore during the quarter. So any thoughts when do you plan to launch here? And also, can you give us some sense on the development that would be happening in Hyderabad?
So in Hyderabad, we'll be adding a residential space of maybe 1 million square feet per plus 1 to 1.5 million square feet, and some of the in Chennai, it will be a combination of residential and commercial, all together maybe in the range of 4 to 6 million square feet. But they're in design stage, and some of the projects are in design stage and a bit of in due diligence, final due diligence stage also. But Bangalore also, the major project to be launched, the Cornerstone Utopia Phase 2, which is actually almost 7 million square feet. There are some approach road issues, what we call here as the CDP road, the development plan road issues near the entry. That is almost resolved, but that may also take about 9 to 12 months, 9 to 10 months or so for launch. And overall, I feel we are in the process of tying up or tied up about 15 million square feet of new projects across these 3 cities.
Sure. And continuing on your real estate business, so far for 9 months FY22, you've seen 6% price hikes. So how much more price hikes do you think will be required to factor in the entire inflation and raw material prices seen over the last 12 months? And secondly, when do you see the organic ASP hikes happening for the industry and yourself? At what point in the cycle do you see that happening?
Probably you have to assume a somewhat similar price hike in the next few months, because post-budget, again, things have started going up. The price of cement and steel have further gone up in the last 2 days. So that way, I do expect inflationary pressures are also there, and it is the bankers expect the interest rates to go up marginally, and all those factors to be seen. But any such price increase, we expect that we will be able to pass it on to the consumer.
Sure. And then secondly, on your retail portfolio, you mentioned that the consumption is now back to 100% of pre-COVID. So consequently, can you help us with what is happening on rental normalization across your tenant categories, and also how do you see the impact due to Omicron?
Yeah, this is Nirupa here. So Q3 was very good for pretty much all of the retailers. By and large, what we're seeing is our collections have been very good. So if you look at it, by and large, we're expecting the rental collection to be maybe 70% of what it was pre-COVID, between 70 to 75% of what it was pre-COVID. We had given a lot of rental relief to many retailers. I would say 85% of them no longer have any COVID relief. So most of it came to an end December 31st. So from Jan, Feb and March, 85% of the retailers are back to paying what they were paying in the lease deed. Of course, because of Omicron in the month of January, there was a lot of disruption because we had weekend curfews, we had restrictions on night curfew. So business did take a beating then. Many retailers have understood it's part and parcel of doing business. There are few requests But by and large, we're going to stick by the lease deed and as per the terms agreed, because now most of the restrictions have been lifted. So in short, I would say we can expect for FY22 about 70-75% of lease rentals compared to what we received in FY20, which was pre-COVID.
Great. Thank you. And one last question on your hospitality portfolio. So you mentioned that corporate bookings now are at around 25% in the last quarter, but your ARRs are closer to 70% of your pre-COVID numbers. So at what level of the corporate bookings do you think that the ARR recovery should be closer to 100% of pre-COVID? That's my last question. Thank you.
This is Vineet here. So as far as corporate bookings are concerned, they continue to be under stress, because of the international travel not starting. And as you would have read the news today, that was expected to start only after this Omicron wave subsides. Having said that, we have been getting about 25% of our hotel bookings are coming from corporates, mostly domestic. In terms of ARR, unfortunately, we expect that to go back to pre-COVID levels only in the next 11 to 12 months, not before that. Because it's a highly competitive market, and all hotels are striving for the same piece of the pie. So I guess we'll have to be a little patient when it comes to reaching the ARR of pre-COVID levels.
Sure. Great. Thank you and all the best.
Thank you.
Thank you. The next question. Before we take the next question, a reminder to the participants to please limit your question to 2 per participants only. You may rejoin the question queue if you have a follow-up. The next question is from the line of Yash Gupta from Angel Broking. Please go ahead.
Good afternoon, everyone. First question is on the announcement regarding the gift city in the budget. How you are seeing the things to be pan out in next 1 or 2 years from now? And is there any change in our strategy?
See, the announcements are all positive, but overnight we cannot expect any big change to happen in a quarter or 2. I expect it may all start happening in 2 quarters or more. Particularly, if someone has to establish a university, foreign university, it is a very big decision, and also any such university will also require a lot of approvals, even if it is a gift city. And the arbitration center also should happen. That may happen faster than the university. Overall, it is moving from strength to strength, I would say. But it is the pace of progress is still not great. See, a lot of, as Subrata said, lot of new transactions have happened in Gift City. But generally, the average size, the ticket size, average ticket size or average area size is is much less compared to an IT sector requirement. This is in the financial sector. These are all in the financial sector. So that way, compared to IT, the space requirements are low.
Okay. Second question on the residential market. So can you give some ballpark number regarding the launch pipeline for FY23? And the second question on the residential market is that we have taken a price hike as our raw material prices have went up, and you are saying that in next 2 to 3 months another rate hikes will be there. So what I just want to understand, when we're going to see a price hike regarding the land parcels that we are having?
So the first question of yours was on the launch pipeline for FY23. Okay, so we normally don't give any guidance, but as Chairman had alluded in the previous comment, currently we have about 2.4 million between this quarter and next quarter. We do expect that we should be able to launch another 6 to 7 million square feet if all goes through in the subsequent quarter. That is what we currently are expecting. But all of it depends on deal closures, approvals happening, etc. And on price hikes, currently because of the cost pressures, we did take price hikes in the Q3. We will continue to take it. The quantums, what we typically do is we don't take huge price hikes. We take small incremental price hikes every 2-3 months. That's typically our style of operation. Because of the current cost pressures, we do believe that we will have to take price hikes as we go along. Also, as we've been seeing market duration and robust performance for all branded players, we feel that we will have a higher pricing ability compared to the smaller developers.
Okay, sure. Thank you.
Thank you. Next question is from the line of Venkat Samal from Tata AMC. Please go ahead.
Hi, thanks. Thanks a lot for the opportunity. So my question is just kind of a follow-up, and I think partly you answered this. So if I just look at the total inventory which is available, which is unsold, at around 5.8 million square feet, that is kind of lowest in the last maybe 5 to 6 years. I understand the fact that, maybe because of a delay in launches, so the number of sales are higher and then it could not be replenished by launches, therefore this is looking lower. So I'm just trying to understand that, moving forward, how are you thinking about launches? So I think you partly spoke about it that, you're looking for 2.4 million square feet in the next 2 quarters and thereafter 6 to 7 million square feet. So that 6 to 7, does it include new land bank that you would be acquiring, or is it from the current development potential itself?
So the 6 to 7 million square feet that we are talking of will be a mix of what we already have and what we will be we are in the process of acquiring or will get done in the next few months. That's what we are talking about, the 6 to 7 million in the next FY. But the question that you are alluding in the first part as to that total current...
Yes, sir. It's just that, we were speaking about maybe 15 to 20% kind of annualized growth, right? And this year we are most likely to miss it. So therefore, how are we kind of setting ourselves up for that kind of a growth moving forward for next year and the year thereafter? So that is my only concern.
So what I'm saying is that we continuously are working towards new land acquisitions, new parcels, etc. The pipeline is quite robust at this point in time. A lot of them are deals in progress. But what we clearly see is that with our ability to acquire land and launch in a quick time, I think we are fairly well geared up to handle the demand that's coming in. As we are very clear that the demand is very strong and robust, and we expect that will continue. So with the area of about 29 million square feet that we already have and the others that would come in, I think we are very well geared up to take up the growth, which would be much better than what we probably see in this current financial year.
Understood. And I think last quarter, you did mention about, being on track to sort of utilize the QIP capital by Q1 of FY23. Any change to that?
See, I think we should be able to. As I said, the money we need is much more than the QIP, what we have raised in QIP. So,
Okay.
Which will be met by, there are internal resources also. So that way we are confident of meeting. But as I said earlier, we have sort of tied up or in the process of due diligence for almost 15 million square feet. So that may require a funding of much more than 500 crores raised. So I think we don't, by and large, we don't see any challenges in that.
Right. And just as a follow-up, sir, so then you are kind of comfortable to kind of increase your net debt on your residential piece, right? Because if we just look at maybe last 4 or 5 quarters, we've been throwing very good cash, right?
Correct. So we are throwing good cash, and we are garnering good cash, and we also have unsold, completed and unsold stock that also will release. More than that itself is 500 plus crores. That also should get released in a couple of quarters. And while the intention is not to unnecessarily raise the debt, but I don't think we should be shy of raising the debt for residential, which is currently at 0.14 is to 1 debt equity. So which is probably one of the lowest in the listed companies.
Right. That is what I was asking. I mean, with the kind of cash flow that we are generating in the residential business, we should be a little comfortable now to kind of lever up a little more than where we are, right? If we are seeing the right opportunity.
Right. Agreed.
Okay, sir. Thank you. Thanks a lot. Wish you all the best.
Thank you. The next question is from the line of Parvez Akhtar from Edelweiss. Please go ahead.
Hi, good afternoon, and thanks for taking my question. So 2 questions from my side. The first one, if it would be possible to get a segment-wise split of the collections during the quarter.
Can you please repeat the question?
If it would be possible to get a segment-wise breakup of the collections during the quarter.
Yeah, sure. So the collections for Q3 for real estate was 840 crores. Around commercial lease was 96 crores. Retail was 38 crores. Hospitality was 78 crores, and maintenance agent PMS was around 46 crores. Total collection was 1095 crores.
And the second question is, when we look at a QOQ basis, then the area which needs to be transacted in WTC Chennai has gone up. So have there been any cancellations during the quarter there?
So the area went up only because of the release of hard options, which were actually earlier tied up with one of the major tenants. So they released because they also have uncertainty with regards to when employees will be back to office. But having said that, we have like major clientele over there, and we are actually hopeful that one of those clients will come back for certain amounts of space. So that's what we are hopeful of.
Got it. That's it from my side.
It was not due to any withdrawal. It was mainly due to the hard option withdrawal.
Hard option. Yes, got it. All the best.
Thank you.
Thank you. The next question is from the line of Samar Sarda from Axis Securities. Please go ahead.
Yeah, thank you. Congratulations for third quarter. Mr. Jaishankar, you mentioned around about 15 million square feet is probably the pipeline or visibility on the projects you're adding up or discussing. Could you just give us a little more color about if at all there are projects which are outright purchases in this, or most of them are JDAs, and what is the breakup, like how much from Bangalore, Chennai and Hyderabad?
See, at this stage, we may not want to give the breakup fully, but I can say it is a good mix of purchase and JDA. But in one case, I sort of gave the answer also about 1.5 million square feet of area in Hyderabad and about 4 to 6 million square feet in Chennai, and the balance will be in Bangalore. So these are all where we have entered into term sheets, and the due diligence is in progress, and in a couple of cases we have entered into the joint development or agreement to purchase also.
Okay. And the land parcel or the JD you've added in Chennai in the last quarter, like would you be launching that in the next fiscal, or like it is still some time away?
Next fiscal should in all 90%, 95% plus probability it should happen in the next fiscal.
A small bookkeeping question for Atul. Atul, if you could just help us with the projects which are completed in this quarter, the third quarter.
Yeah, it's around 4 lakh, around 8 lakh square feet which has got completed, and we have also sold around 1 lakh square feet from our finished stock.
Okay, sorry, which was this project which got completed?
This is Seven Gardens and Plumeria Lifestyle.
All right. Thanks a lot, and all the best for the rest of the year.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. I would like to remind all participants present in this conference, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Adidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, sir, my question, thanks for the opportunity once again. My question is, sir, we are going to build a mall with Prestige in Chennai, where we had a minority stake. So any update on the progress of that project, when that construction is supposed to be started?
After the approvals are received, but I suggest kindly ask this question in the analyst call of Prestige Group thing, so that they are the senior partners in that. So it may be, they will be in a better position to answer. But if you ask me, in the next financial year, it should happen.
Okay. Sir, next question is on Twin Towers. So have we started looking to pre-lease that tower over there? Any movement on the leasing, or it is still some time away?
So I would say it is still some time away. We are responding to RFPs. But the general sentiment currently, particularly for under construction projects, is lower than completed projects. So that way, I expect to see if there is no fourth wave, the thing should come back sooner than later.
Okay. Then what would be the market rate of rental in that locality right now? Around the market rate for office rentals?
In that localities, it is anywhere between 70 to 80 rupees. In that range.
70 to 80, the base rental. Okay. Fine. That's it from my side. Yeah. All the best. Thank you.
Thank you.
Thank you. Before we take the next question, a reminder to the participants, if you have a question, please press star then 1. The next question is from the line of Richam from HDFC Securities. Please go ahead.
Hi, sir. Parikshit here from HDFC. So I have just one question on this 15 million square feet pipeline. So by which quarter or by which half of next year we expect to close this? And how much of cash outgo will happen on closing this?
I would say we expect to close the transactions maybe in 2 quarters or so, before say September quarter. I'm graded. See, if there are a dozen transactions, each one will take the different timeline. But everything hopefully should happen in before the September quarter. And overall requirement, I did mention it is 500 crores plus, and which we are able to fund from the internal resources and QIP.
500 crores will be the cash outgo. And how much will be the gross value which we will be able to add here?
I will tell you subsequently. Yeah, I will tell you subsequently, because it is the nature of product. Everything needs to be decided. It is in the design stage. It is based on that we will have to arrive at.
Okay, sure. Thank you, sir. That was my question.
Thanks.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Kaushagya from Old Bridge Capital. Please go ahead.
Yeah, thanks for the opportunity. This is Kushagra. Few questions. Most of the questions got answered. First, when you're talking about building up the pipeline, how much cash you are probably thinking of spending towards project acquisitions, land acquisitions over the medium term? Second, a related question to it. Since you're talking about raising debt in the residential part of it, what are the comfortable levels in terms of debt to equity in the residential segment?
See, as I said earlier, the requirement is upwards of 500 crores, more than what is raised in the QAP, and I did say we are able to meet the requirements in internal resources, and if required, we will be able to raise some debt also. Currently, it is 0.14:1 is the residential debt. Even if it is 0.5:1 or 0.6:1, it is considered very, very acceptable. As many developers who are only in residential, they have a much higher debt equity ratio of even probably 1:1 and more. So that way we are okay.
Sure. Okay. Got it. Got it. And second question on any update on your hospitality selling of the hospitality segment? Like you
see, as soon as the interest levels go up by interested funds, there is another wave of COVID. So then everything comes to standstill. So we are waiting for the right opportune time. It is to dilute the equity. So whenever it is, thankfully, all the hotels are performing fairly well in Q3. Of course, January it has taken a bit of a hit, and but I think within a week it has started showing marginal improvement, and this can only go up. And generally, if there is international travel, like January, February to June is one of the best periods for hospitality business.
Okay, sure, thanks.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Ms. Pavitra Shankar, Executive Director, for closing comments.
Thank you. Thanks all for listening in. Here's a few other highlights from our end. The Brigade Group celebrated its 35th anniversary in October 2021. Brigade Towers, a 15-story commercial building on Brigade Road in Bangalore, was the first project started in 1986 as a partnership company. Since then, we've come a long way from a single project firm to a multi-product, multi-city developer with many landmark projects and recognitions, incorporating as a private limited company in 1995 and going public in 2007. We would like to use this opportunity to thank all our customers, investors, associates, and all other well-wishers for the trust they have placed in us over the years. We stand committed to our mission, vision, and values that have brought us to where we are today. We will continue to live by these standards. We also think it's fitting to touch upon the recently announced budget. We believe it's unique in the sense that this is the first time a government has laid out a vision for 25 years. It lays a lot of emphasis on infrastructure and is forward-thinking with respect to climate change and the digital rupee. Although not much for our real estate sector and the middle class, the Emergency Credit Linked Guarantee Scheme, or ECLGS, is a welcome relief to much affected MSMEs and the hospitality sector. Coming to an interesting initiative from our end, I'm sure you're all aware of Brigade's flagship CSR initiative in arts and culture, the Indian Music Experience Museum, or IME, in Bangalore. The IME is coming up with its latest offering, an exhibition called Bird Song, which for the first time brings together music and ecology via the world of birds. The exhibition opens in April and comprises both a physical and online component. Do visit if you can. The latest exhibit is also in line with Brigade's core values of being socially responsible and in line with our commitment as an organization to sustainability by creating environmental awareness and action. Our real estate accelerator program, Brigade REAP, set up India's first PropTech syndicate fund on the Let's Venture platform. Structure, which is a REAP startup working in creating sustainable construction material using agri-waste, raised 30% of its total fundraise via this platform, and it was successfully closed in just 30 minutes. Despite the sudden surge of the third wave over the last few weeks, it's good to see the Omicron variant is already waning. We hope the worst is behind us with respect to COVID. What with booster shots getting rolled out, the variants decreasing in their severity, and many countries removing their COVID restrictions entirely. I can speak for everyone here when I say let's look forward to a year filled with hope. We will work toward realizing our goals, and we look forward to healthier and happier times. With that, we now wrap up our Q3 FY22 analyst call. Thank you all for taking the time to hear from us today. Stay healthy and stay safe.
Thank you. On behalf of Brigade Enterprises Limited, we conclude today's conference call. Thank you all for joining. You may now disconnect your lines.